Now with the changes to the tax credit regime with respect to renewable energies from the IRA, REITs not only can earn more credits, but they also have an avenue of monetizing them by transferring them to third parties for cash.
Joining me today is Julanne Allen, principal with PwC. Thank you so much for joining us today.
Thank you, Matt. Thanks for having me.
Now, before you started working for PwC, you worked at the IRS branch that oversees REIT issues. How has your perspective of the REIT industry changed with your new role?
Since joining PwC and leaving the public sector, I've really come to appreciate how quickly and novel issues arise in the course of operations and business dealings with REITs. So for example, a REIT can be interested in acquiring a new type of property, a new class of building, or perform new services at that building. The rules relating to this are quite old, and applying old law to new modern facts sometimes can be quite challenging. I've also noticed how well the REIT industry polices itself, so ensuring that we are all working towards maintaining REIT qualification and complying with the REIT rules.
The Inflation Reduction Act enacted transferable energy tax credits. At a high level, what are some of the opportunities and issues for REITs in connection with these transferable tax credits?
Well, prior to the Inflation Reduction Act, or as commonly called the IRA, REITs had a limited ability to even earn federal tax credits. And even if they earned them, they frequently didn't have any taxable income or tax liability to use those credits to offset against. Now with the changes to the tax credit regime with respect to renewable energies from the IRA, REITs not only can earn more credits, but they also have an avenue of monetizing them by transferring them to third parties for cash. That cash is not considered gross income to the REIT, and the REIT doesn't have to distribute it to its shareholders. It can be used for operational expenses or just for reinvestment in assets. One thing to note with the IRA credit regime, though, is it's very intensive as far as documentation and the mechanics of transferring the credit to a third party. Another thing to keep in mind is that there is a 5-year recapture period. So in the event that the asset is disposed of, let's say, within that 5 years, a portion of the tax credit will be recaptured, and the entity that holds the risk of recapture is the buyer of the credit. So the REIT, as seller of a credit, will maintain a 5-year relationship with the purchaser of this credit.
And finally, can you describe some of the unusual issues faced by REITs as a result of the impermissible tenant services rules?
The impermissible tenant service rules, or ITSE rules, are quite harsh. In the event that a REIT has 1% of its revenue at the property from impermissible tenant services, the entire income from the property is considered bad income. That's a very harsh result. Frequently, REITs try to avoid earning any ITSE at any property. And in doing this, a close evaluation needs to be done on the services being provided, whether the REIT can provide them without using an independent contractor or taxable REIT subsidiary. If the services are services that the REIT itself cannot perform, it needs to hire an independent contractor from whom it does not receive income or use a taxable REIT subsidiary. The nuances related to the use of independent contractors and taxable REIT subsidiaries are quite complex, and a close discussion with your tax advisor may be necessary.